Welcome back, everyone. Today we are diving deep into a topic that is quietly reshaping global finance, Japan's interest rate shift and its ripple effects across the world. If you think the world of finance is only about numbers, think again. This is about incentives, human behavior, risk, and the flow of trillions of dollars across borders. And trust me, once you understand this, you'll see why global money moves in ways that most people completely miss. So let's start at the beginning. Japan, for decades, has been the poster child for ultra-low interest rates, even negative rates in some periods. For a long time, this created a strange scenario in global finance. Imagine a Japanese pension fund managing billions of yen. The domestic interest rates were so low that keeping money in Japan didn't really earn anything. Zero or negative returns were the norm. That created an incentive, and an incredibly strong one at that, to look abroad for higher yields. Now, the United States, with its higher interest rates, became an obvious destination. Dollar-denominated assets, whether treasury bonds, corporate bonds, or other financial instruments, offered significantly higher returns than what Japan offered domestically. So for years, Japanese investors, especially large institutional investors like pension funds and insurance companies, moved a lot of money into U.S. assets, and they weren't alone. Global hedge funds, endowments, and international banks all engaged in similar trades. The result: massive capital flows from Japan to the United States, but here's the thing, it wasn't just about interest rates. When Japanese investors buy U.S. assets, they aren't just lending money, they're also taking on currency risk. You see, when you convert yen to dollars, your returns are affected by the exchange rate between the two currencies. If the yen strengthens against the dollar while you hold dollar assets, your gains in yen terms shrink. If it weakens, your gains grow. Now, historically, this risk was mitigated using something called currency hedging. Essentially, investors could enter into contracts to lock in an exchange rate, ensuring that currency fluctuations wouldn't eat into their returns. But there's a catch. Hedging isn't free. It comes at a cost, and depending on the interest rate differential between the two countries, that cost can be substantial. In fact, it can completely offset the yield advantage of holding foreign assets, and this is where Japan's recent interest rate policy changes become so critical. Japan has started to raise interest rates. Even modest increases make a huge difference in the world of high-value institutional money. Suddenly, keeping money at home starts to look attractive again. When you factor in the cost of converting yen into dollars and then back again, combined with hedging costs, the supposed advantage of U.S. yields basically evaporates. In some extreme cases, it actually turns negative. You heard that right. Japanese investors could be losing money simply by holding dollar assets and hedging their currency exposure. So what does this mean in practical terms? Well, whether you are a Japanese pension fund or a global hedge fund managing billions across multiple currencies, this is a red flag. You start to reconsider your allocations. You start to look at your dollar-denominated assets and ask, does it still make sense to keep this money abroad, or should I bring it back home where the returns are now competitive? And the answer increasingly is bring it home. This shift isn't trivial. We are talking about potentially hundreds of billions of dollars in capital moving back to Japan. That kind of movement has a massive impact on global markets, including U.S. Treasury yields, the dollar exchange rate, and even global equity markets. Let's break this down further. Suppose a Japanese pension fund has invested in U.S. Treasuries. The nominal yield might be 5%, while Japanese rates are only 0.5%. At first glance, this looks like a massive gain. But once you consider the hedging cost, which could be around 4–5% depending on interest rate differentials and market conditions, suddenly your net yield in yen is close to zero. And now with Japan's rates rising to, say, 1% or 1–5%, your domestic investments start to look competitive. You're earning nearly the same without any currency risk, without having to hedge, and without the hassle of international transactions. That's a game changer. The implications extend beyond just Japanese investors. When Japanese money leaves the U.S., it impacts dollar liquidity. Demand for U.S. assets drops, which can put upward pressure on yields. Remember, bond prices and yields move in opposite directions. Less demand for U.S. Treasuries can lead to higher yields, which in turn affects borrowing costs for the U.S. government and influences global capital markets. Currency markets are affected too. Selling dollar-denominated assets and converting them back into yen increases demand for yen relative to the dollar, which strengthens the yen. A stronger yen has consequences for Japanese exporters, as their goods become more expensive overseas, potentially affecting Japan's trade balance. It's a delicate balancing act between interest rates, currency valuation, and economic growth. And let's not forget hedge funds. Global hedge funds have been playing the U.S.-Japan interest rate differential for years. They borrow in low-yielding currencies like the yen to invest in higher-yielding assets like U.S. Treasuries, a strategy known as the carry trade. But with Japan's rates rising, the cost of borrowing in yen increases. Suddenly, the carry trade becomes less profitable, and some trades may even start losing money. Hedge funds may begin unwinding these positions, adding further pressure on U.S. assets and impacting volatility in currency markets. The broader lesson here is about incentives. Finance, at its core, is about chasing returns while managing risk. When the incentive structure changes, even slightly behavior changes. Japan's interest rate hikes are one of those shifts. It may seem small in absolute terms, going from near zero to a little over 1%, but for global capital flows, it's massive. Now, some might argue, but U.S. interest rates are still higher than Japan's, so money will stay in dollars. And technically, that's true. The headline rate differential still favors U.S. assets, but the devil is in the details. When you consider currency hedging costs, transaction fees, and the risk of exchange rate swings, the effective advantage often disappears. You're no longer earning a meaningful premium by holding dollars. In some cases, as we've discussed, you might even be losing money compared to staying in yen. Let's also consider the psychological aspect. Institutional investors are not just number crunchers, they are human beings influenced by certainty, predictability, and the perceived safety of their home markets. Even if a small nominal advantage exists abroad, the uncertainty, hedging costs, and administrative overhead may lead decision makers to prefer domestic investments. When Japan's rates rise, the relative attractiveness of keeping money abroad decreases not just mathematically, but psychologically. Another important factor is liquidity. Japan's domestic markets are enormous, and as rates rise, more capital flows back into them, increasing market depth. More liquidity makes it easier for institutions to invest efficiently without moving markets dramatically. This, in turn, creates a self-reinforcing cycle. More money returns home, increasing domestic liquidity, which encourages even more investment domestically. So what does this all mean for global markets? First, the U.S. could see slightly higher bond yields if Japanese capital flows reverse. Second, the dollar could weaken as yen demand increases. Third, Japanese equity markets could get a boost as domestic investment picks up. And finally, global hedge funds that rely on cross-border interest rate trades may need to rethink strategies. potentially increasing volatility in multiple asset classes. In conclusion, the shift in Japan's interest rate policy is far more than a domestic story. It's a global event. It changes incentives, alters the flow of capital, impacts currency markets, and even affects risk appetite worldwide. For investors, this is a signal to reassess portfolios, review currency exposures, and consider the long-term implications of capital allocation decisions. The key takeaway is simple yet profound. Finance is never static. Small shifts in interest rates, especially in large economies like Japan, can cascade across the global financial system in ways that are easy to miss but impossible to ignore. Whether you're managing a pension fund, a hedge fund, or even personal investments, understanding these dynamics is critical. So, next time you hear about interest rate changes in Japan, remember, it's not just about Japan. It's about trillions of dollars moving across the globe, incentives changing overnight, and a complex web of financial decisions that affect economies, markets, and ultimately, our daily lives. Stay tuned, keep an eye on Japan, the U.S., and global flows, because this story is far from over. And if you want to understand global finance at a level most people don't even see, this is exactly the kind of scenario that will teach you the ropes. Thank you for watching, and if you haven't already, subscribe to stay updated on deep dives into global finance, economic trends, and market-moving insights. Knowledge like this is power, and the sooner you understand it, the better prepared you'll be for what's coming next.